Excellent. Good morning, readers. I am delighted today to be joined by Richrd Roberts, Director and Head of Investor Relations at Oxford Capital. Richrd, thanks ever so much for your time. Please, can you why don't you give us a little bit of background about yourself and Oxford Capital to start with?
Yeah, thanks, Alex. Thanks for the opportunity, especially in lockdown, to do this. A little bit of background on me. I've been at Oxford Capital for coming up to 6 years. I head up the investor relations team, and that really focuses on the client side of the business. So things from marketing, communications, through to our distribution channels and interactions with our advisory community. Most important, all of our investors and the reporting that surrounds that. In terms of Oxford Capital, obviously we're one of the oldest investment managers within the EIS world. We've been sort of going for approximately 20 years. We've raised and invested over £450 million into a variety of early stage companies, from renewables through to media. We currently are focusing our operations on our technology and venture EIS fund. We currently have a portfolio of about 30 odd companies within that. Performance is doing well.
Richrd, thanks for that. Please, how would you describe your investment strategy?
Yeah, so our investment strategy is really looking to support what we consider the best of British companies. So businesses that are solving commercial, technical or scientific problems in innovative ways. We're looking to support credible, talented and highly driven entrepreneurs to do that and deliver their business ideas.
And so how would you describe, do those companies fall into any sort of categories or any different types? How would you describe those?
So they probably fall into two core categories. So what we consider high potential, and these are generally deep tech companies that are developing groundbreaking technology. To give you an example, we have a company called Zyhelm, which is in the portfolio, and this is a tomato picking robot that's looking to revolutionize the way that growers across the world harvest stock. So tomatoes is one of the first sort of focal points, but it can do anything, and the idea is to sort of really allow that to develop out and become a world-leading company. On the other side of the coin, we're looking for what we consider early growth. So these are really tech-enabled companies that are disrupting existing markets. And we're looking for sort of a product market fit stage when we're investing. Can we actually help these companies exploit slower moving incumbents? So a good example of that would be a company called Moneybox, which many of the advisors may have heard of, and many of their clients may be actually using as an investment tool for their ISAs. And that is a company that allows investors to save money directly through their mobile devices and build assets.
What about, is there a sort of type of personnel, type of entrepreneur that you're looking to sort of back, within these businesses, Richrd?
Again, I mean, the core focus really is, are they driven? Are they talented? We have a very diverse portfolio, but it's really people that are looking to exploit existing markets, use their experiences. Many of our entrepreneurs have actually either had businesses before or worked in industry and really spotted market opportunities to then go and exploit.
Richrd, what about, we hear so much about ESG investing at the moment. What's your philosophy? What's your thought process on that?
Yeah, so ESG is really something that we feel very strongly about, both internally within Oxford Capital, and then when it comes to sort of choosing and investing in companies, we're looking to both back companies that have got the potential to have a positive impact on the environment and society as a whole. What we think really is our role as a VC investor, especially when it comes to ESG, is within small companies. Often the thought of ESG is for much larger companies. It's something to do when they get to a much bigger stage. But actually, we can influence how they go about adopting best practice within ESG and their policies, and really helping shape those companies to become responsible companies. And we actually find that they, by adopting these ESG policies, they've got a much stronger level of growth in their overall potential.
Okay, and what are these sort of, within the companies you've got within your existing portfolio, what are the sectors they're involved in?
Yeah, so the sectors covers a wide range. Obviously, we're trying to build a diverse portfolio for our investors. So we cover from things like artificial intelligence and machine learning. We've got a number of investments into digital health, fintech, and insurtech form a large part of our portfolio. And we also look at things within the e-commerce world, the future of work, and the future of mobility.
Excellent. Okay, so tell me more about from an investment point of view, or from an investor point of view, what are your specific goals and objectives?
Well, for investors, what we're looking to do is really help them build a portfolio of alternative assets to sit alongside their core investment portfolio. So when it comes to them making an investment with us, we're looking to build a portfolio of approximately 8 to 12 different companies that cover a variety of different stages, geographies, and sectors, and really allow them to access sort of high potential companies at early stages in their growth.
Richard, so tell me more about the sectors you specialise in and why these are important.
Well, the sectors that we're looking to specialise in are really where we think there is the highest growth potential. And when you look at what's kind of happening in the market at the moment in a sort of post-COVID world, the incumbents within retail, within the workplace, there's going to be a huge amount of disruption, and we're looking to really back companies that are ready to exploit the opportunities that are coming in the next 12 months and the next sort of 3 to 5 years, and really becoming the FTSE 100 companies of the future. So when we're looking at where we're going to invest, we're looking at different themes. So as I've sort of said, the future of mobility is a core theme, the future of retail, the future of work. These are things that we're looking at. And then we're looking at about how can artificial intelligence and machine learning really enhance some of those opportunities and allow for explosive growth within these early stage companies.
Excellent, thanks, Richard. That was great. Okay, let's now look at another important factor, which is obviously risk. Within these investments, where does that fit within your philosophy, really, and how do you manage risk?
Yeah, so risk is obviously sort of key within early stage investing. Investing into EIS as a general sector is obviously very, very high risk. So risk management sits at the core of our portfolio construction, and it begins as early as the initial screening and the amount of companies that we see through the due diligence process. But the key sort of factor that we have as the central tenets within the portfolio construction is twofold. The first one is really to sort of invest early. Okay, so we're investing from late seed stage. We're often the first institutional investor that will come into a company's round. When we're building a portfolio for our investors, we're taking a small amount of their initial subscription and investing it into maybe 3 or 4 early stage companies. We then look to back progress. So invest early is the first one, and backing progress is the second piece. As companies look to grow and require more money, if they're demonstrating that their business model's working, they're hitting their KPIs, and really growing quickly, we'll look to follow on, and we'll look to back companies that are emerging as winners. So when it comes to our investors' subscription, approximately 60% of their subscriptions going on to these later stage companies, so from Series A all the way through to Series C rounds. So these are companies that have demonstrated product market fit. There is less risk than the very, very early stage. And therefore, the investors are getting a much more of a blended opportunity for a variety of different investments rather than everything being at a very, very early stage. And that helps manage both investment risk of sort of progress and progression within each company, but also duration risk for their overall investment. So not every single company is going to take potentially 7 years to exit, because if we're investing at a later stage, hopefully they're reaching a maturity point much earlier.
Richard, tell me, as an investor, what are the main challenges that you face?
So the main challenges that we face sort of split really into 2 parts. Obviously, trying to identify and work with these early stage companies and helping shape them to become winners of the future, is incredibly difficult. It takes huge amounts of effort and hard work from our investment management team. But on the other side, it's trying to manage that dynamic as well between the advisor and the investor, and ultimately, the investment timeline to build these companies. These are early stage. They're going to take a while to both build and develop products to be of sufficient value to then get out. And there is a tension between EIS, tax relief, and building high value companies for the long term. And EIS, this 3-year sort of holding period to ensure qualification, often dictates an exit time horizon that's shorter than it actually takes to build very valuable large scale businesses. Managing that dynamic is a key challenge that we encounter on a daily basis. It's one that we manage by educating both the advisors and investors, and really our risk management and our portfolio construction is helping really ensure that that's managed across the investment timetable.
That's a really good point. Yeah, there are two elements at play there, aren't there? So yeah, that's got to be a good, careful juggling act. And I know sort of looking after your investing companies and their personnel is something we're going to touch on a little bit later. But I've got to ask, in terms of obviously the last 12 months has been a completely different kettle of fish with the pandemic. How's that affected the business, or what have been the challenges you faced as an investor around that?
Yeah, so the last 12 months have been really fascinating. I think the initial shock of going into lockdown sort of just over a year ago, was one that really affected the UK as a whole, but within our portfolio, there was a lot of nervousness within entrepreneurs and the founders, how is this going to affect their businesses, and how were they going to respond to the challenges? Did they have enough cash to be able to sort of see them through this difficult period of time? That's a key central tenet when we're making investment is, to ensure that these companies have got strong enough balance sheets to at least see them through a rolling 12-month period. So, the founders that we've backed have been incredibly resilient. They've really adapted to the challenges. They've risen to meet them head on. They've adapted how their businesses operate, often making them more efficient through the impact of COVID, by adopting technology, reducing unnecessary overhead. And actually a lot of the portfolios come out much stronger because of COVID, because they've had to become leaner and more focused on what they're doing, rather than allowing them to sort of become overly inflated. So COVID has been a huge challenge for everybody, and it's been incredibly wearing, having to have Zoom calls for hours on end. But what we found from our portfolio and really from our founders, that they're incredibly resilient, and they've adapted and they've met the challenges head on. Actually, I think their businesses are going to become better for it.
That's great to hear. What about just in terms of being part of the Oxford cluster? I've heard a lot about that in terms of supporting newer growth businesses. Has that helped?
Yes, the Oxford cluster's sort of very hot at the moment. I think the AstraZeneca vaccine has really helped draw attention back into the cluster. But we're sort of central supporters of the tech-enabled businesses that sit within Oxford and the surrounds. We're a key supporter of early-stage businesses, and we're very well networked in with a lot of the other early stage supporters within the universities and other VCs in the area.
Excellent. Okay. What about that's again good news. Just what about Oxford Capital in terms of business? How have you changed over the last 12 months? Both in terms of the pandemic or anything more sort of existential, I guess, in terms of the business.
Yeah, we've had to change our working practices. We've become a fully digital organisation. I think we've embraced that. We've recruited new staff and we've increased our headcounts. We've moved office. We've gone to a full sort of hybrid working structure. And actually, it echoes what's been happening with our portfolio. We've looked at better ways of working, using technology to improve what we're doing. and really becoming a much more efficient business overall. And the learnings that we've taken on internally can then actually be shared with our portfolio companies across the board. We've got different companies at different stages in their growth, and not all of them want to go through sort of learning the hard way. If we can share experiences across the portfolio, both of what we're doing and what other companies are doing, it really benefits everybody.
Looking slightly broader at the sort of companies that you're able to invest in, looking at the UK as a whole, I think it's fair to say we've always had a strong startup and entrepreneurial culture. In your experience, what do you put that down to, Richrd?
Yeah, I think the UK is a great place to both do business and invest into, and not just UK investors investing back into the UK, but it's a great sort of pull for money from across the globe. That kind of falls into a few categories, really. You've got obviously the government support from the EIS scheme. That allows huge amounts of private capital to go into early stage businesses and helps mitigate some of the risk that the early stage companies present. It also provides opportunity for investors to broaden out and diversify their core portfolio. So government support is really key. Obviously, the universities that we've got within the UK and the academic excellence, they playing a huge role in developing the digital economy and providing a skilled workforce to take advantage of new opportunities as they come through. And obviously, there's a huge amount of focus on supporting and investing into the regions. This is not just London focused. There are huge initiatives going on to support the regions and pushing money down into businesses and companies all over the UK.
Thanks, Richrd. You mentioned EIS as being a key sort of support there, factor within the UK's entrepreneurial culture. Are there any fears that future government changes could undermine the effectiveness of various schemes and EIS in particular?
I think it's always a concern, if the government look to make changes around EIS. Obviously, the most recent budget, where there were potential for changes, there were no amendments made, and I'd be really surprised actually if the government did decide to change the way that the EIS scheme works. It's been the last 25 years. It's been a hugely successful vehicle for taking private money and really pushing it down into early stage companies, and really that's where the value and the recovery from the impact of COVID is going to come. It's going to be all of these new companies that are exploiting opportunities that COVID has both presented and created. And if the government begin to sort of disincentivize, private money by supporting these companies by impacting tax changes in the short term, they're only harming themselves. The government can't foot the bill for the COVID recovery. It has to come from a much broader base. And really the EIS scheme is a great way of channeling that money into the businesses for the future. So I'd be surprised if they make any changes.
What about in terms of if you could influence positive changes to the scheme, what would you suggest that the government looked at?
Yeah, so it's a really good question. I think positive changes is sometimes doing nothing is a key thing. The temptation to change just for the sake of it. So my key message to the government would be, don't change. This is going to be the one of the sort of engines that's going to fuel economic recovery within the UK. I think the tax breaks are set very well. I think the only sort of suggested change would be possibly relaxing some of the qualifying criteria for some of the companies to access EIS tax reliefs. And again, I think the patient capital review did a very good job, but ultimately it's limited the scope of the EIS quite considerably from where it was sort of 5 years ago.
Richrd, fantastic. So tell me, how do you think EIS investments can actually work to diversify or be used to diversify a client's portfolio?
Yeah, so the EIS is an alternative asset class. It is designed to be an accompaniment to core financial planning. But really, this is providing the potential for both tax efficient investing, which is relatively limited in what I would classify as a modern standard portfolio, but it's really providing some serious high potential growth where, in current markets, there's a stagnant element to it. There's a level of uncertainty within the sort of core FTSE, for example, and this can be a real driver for both advisors to build out their own businesses, but also to build out a growth element within a modern sort of investment portfolio.
Excellent. Yeah, I do think there's another opportunity for advisors to absolutely sort of broaden their clients there and the work they're doing with. So that's great. What about in terms of I guess the chicken egg question there is do you think advisors and their clients are more savvy about EIS and SEIS? 25, 26 years now. But do you think advisors are savvy to those benefits about how to use EIS?
Yeah, I think they're becoming increasingly more savvy. There's a much more mature market. When you look at the number of companies that are offering EIS investments, it's significantly greater than when Oxford Capital started 20 years ago. I think one benefit of having a much broader sort of marketplace is the level of research and information that advisors and clients can get access to. It's much more readily available. There's a much greater ability to compare and contrast managers and the underlying performances of portfolios. So I think there is a much greater knowledge level within the advisory community and within investors. I think that can continue to be improved, and we are strong supporters of being providing advisors with collateral and information to help them understand both EIS as a tax relief and how that can be used, but also how that can, how investing into the venture capital market really works. What are the dynamics? How does it work? And we really want to facilitate advisors and then ultimately their investors with the knowledge so that they can make sound investment decisions to build out their portfolios. So I do, however, think they're missing a slight trick as well there. So that investors are becoming more savvy, and I think advisors are slightly missing a trick when it comes to how to use EIS to build their own businesses. And I really sort of would use the dinner party chat as an analogy for that. It's very rare that you'd ever go out with a group of friends, and I know many advisors won't like this, but sort of changing their investment allocations in their pensions and how the performance of their FTSE track is doing. It's not sort of great chat for most people. Whereas when it comes to EIS investment and making direct investment into small companies, that's a completely different kettle of fish. The emotional connection is much greater. So somebody saying to one of their friends, let me tell you about this fantastic tomato picking robot company that I've just been invested into, or about a driverless technology car company that I've been invested into. That's something that people can really associate with, and actually, because it's new, it's innovative, it stimulates conversation. It's then going to in turn stimulate referrals and new businesses for advisors. And I think that's something that if advisors can really understand both the risk and the opportunity within venture capital, it's something that they can really leverage to build their own businesses.
Are you able to help advisors, and support them in any way and sort of talking to their clients about these issues?
Yeah, so we really are strong supporters of advisors and really how they interact with their clients. So we want them to help build their own knowledge base. So we've got a huge amount of collateral that we provide, both within how to use EIS in certain case studies, both from a tax planning perspective, to reduce income tax or capital gains tax deferral or inheritance tax mitigation. So case studies to illustrate how they can utilize EIS. We have a number of seminars that we run, either on a group basis or one-to-one. We've put professional development, CPD modules together, so people can both access more knowledge and become better qualified at doing that. So yeah, we're strong supporters of facilitating advisors with information and knowledge.
Just a final question for me, Richard, there is just on the industry, but does the industry need to do more to promote alternative investments, to a wider investor base?
Yeah, this is a real challenging one because, investing into small companies and within the EIS scheme is obviously very high risk. That's why the tax breaks are there, and therefore it is not for everybody. When we talk to advisors and talk to investors, getting them to understand what they're investing into is key, and therefore the knowledge and the suitability is really a high benchmark for us. So there is a large demand building within the marketplace, though. When you look at the rise of platform investing, direct investing through the internet into small companies, there's a huge pull. But actually, people really need to understand the risks of investing in small companies. So, yes, there is more scope, but ultimately it needs to be done within the right people. It's not for everybody because of the risk factors. However, for those people that are prepared to take the risk and are of higher net worth to have the capacity for loss, it's a really good alternative investment to sit alongside their portfolio.
Thanks, Richard. And just before we wrap up, if there was sort of one or two key messages you'd like to pass on to our advisor readers, about in terms of Oxford Capital, where you're at now, and sort of as a summary, what would that be?
Yeah, so the key sort of message from Oxford Capital is, we are very experienced venture investors. As I said, we've been investing and supporting UK small companies for the last 20 years. We have a fantastic portfolio of highly accessible companies that are doing well. We have a very clear investment strategy as to how to both access these early stage companies, but do it in a risk managed environment, with a clear message as to portfolio construction, risk management at the heart of what we do. We believe that accessing EIS investments, doing it through our growth EIS, is a great way to to diversify portfolios for investors and their advisors.